If you open up Newmont Corporation's Q1 SEC filing, you probably expect a boring, emotionless letter.
Oh, absolutely. Just endless columns of numbers.
Right, fine print that's basically designed to put you to sleep.
Mm.
But instead, you find a 4.5 magnitude earthquake, raging bushfires, a bitter corporate betrayal, and, well, an 80-year-old ghost of a tunnel.
Plus gold trading at an absolutely historic $4,900 an ounce.
Exactly. So today we are tearing apart a single financial document to show you how modern global mining reads exactly like a geopolitical thriller.
It really is the ultimate test of high-stakes corporate survival. I mean, you are watching a company navigate this crazy collision between raw geology, global high finance, and just intense geopolitical friction.
Yeah, and if you're listening to this deep dive, I know you don't just want the top-level headlines. You want to know how the actual machinery of the global economy works.
Which is why our mission today is to dig into Newmont's Q1 2026 Form 10Q, which is essentially their legally binding quarterly confessional to the government.
Yep. That, along with their corporate governance documents. We're going to extract the hidden narratives that dictate, the materials in your smartphone, the stability of your investments, and the physical backing of global trade.
But before we get into the literal earthquakes and lawsuits, it's really worth taking a second to look at how Newmont visually presents itself to the world in these exact sources.
Oh, right. Visually, it sets the stage perfectly.
It really does.
If you look at their logo on the cover of the filing, it's this solid, steady blue word mark spelling out Newmont. But the left leg at the end is a striking, sharp gold triangle.
It's a mountain peak.
Exactly, a mountain or a pyramid of gold. It's a very clear symbol. It basically says we extract extreme wealth directly from the earth.
But as the pages of this 10Q reveal in agonizing detail, the Earth does not give up that wealth without a serious and sometimes violent fight.
So how does a single company navigate this chaos? Okay, let's unpack this, because before we can talk about the struggle, we have to talk about the prize.
And the prize is unprecedented right now.
I know the macroeconomic climate for precious metals has been wild lately, but how did that actually translate to the balance sheet for Newmont in the first quarter of 2026?
Well, the numbers are just staggering. According to the filing, Newmont's sales for the first quarter hit $7.3 billion.
Wow.
Yeah, and their net income, so the actual profit left over, was $3.26 billion. That translates to $3 per share.
Which is huge.
Right. To put that in perspective, that is a $1.37 billion jump from the exact same quarter just 1 year prior.
Wait, a $1.37 billion increase in profit in a single year. That's not just organic growth. Something structural had to happen. What is the driver there? Are they just digging twice as fast?
Not at all. It's almost entirely about the value of what is hidden inside the rocks they're moving.
Okay.
The average realized price of gold for Newmont in this specific quarter hit a stratospheric $4,900 per ounce.
Unbelievable.
And silver jumped to almost $67 an ounce. The global market basically handed them a historic premium.
$4,900 for a single ounce of gold. I mean, that is an absolute historical anomaly. And here's where I get confused looking at the narrative in the filing.
Okay, what stood out?
If you are sitting on operations that pull gold out of the ground, and gold is suddenly worth $4,900 an ounce, wouldn't you want to hoard every single operation you own?
You would think so, yeah.
Yet the filing goes into deep detail about a massive divestiture program they just finished.
That's right. Throughout 2024 and 2025, Newmont aggressively sold off what they call non-core assets. We're talking about offloading entire functioning mines.
Like which ones?
They sold CC&V in Colorado, Musselwhite, Eleanor, Porcupine, Akiem, Coffee, and Telfer. They just completely removed them from their portfolio.
Why in the world would you sell a gold mine during a historic gold rush?
Because in mining, revenue isn't the only metric that matters. It's about the margin. What Newmont did was pivot strictly to what the industry calls Tier 1 assets.
Which are the massive ones, right?
Exactly. A Tier 1 asset is an incredibly rich deposit that can produce a huge amount of gold for decades, and crucially, do it at a lower cost per ounce.
I see.
The mines they sold were productive, sure, but they were more expensive to run, older, or just had shorter remaining lifespans.
Okay.
By selling them, Newmont drastically lowered their overall metric called costs applicable to sales.
I really like to think of it like pruning a fruit tree.
Oh, that's a good way to look at it.
Yeah, if you leave every single branch on the tree's energy is spread way too thin.
Right.
Right? Yielding thousands of tiny, bitter apples.
Right.
But if you intentionally prune the weaker branches, like divesting those non-core mining assets, the root system pumps all of its nutrients into the few remaining branches.
Creating massive, highly profitable fruit.
Exactly. They consolidated their focus right before the market peaked.
What's fascinating here is the sheer mastery of that corporate timing. I mean, they reduced their operational footprint and leaned down their cost structure just as commodity prices skyrocketed.
Yeah, their timing was impeccable.
And why did gold hit $4,900? The SEC filing explicitly notes the drivers: global geopolitical tensions, runaway inflation, and military conflicts.
Right.
Newmont positioned themselves to have only their highest margin operations running right at the exact moment the world decided it desperately needed a physical, safe haven asset. It's a masterclass in margin optimization.
So the financial weather is absolutely perfect for them. It's sunny and it is raining cash.
Quite literally.
But because they pruned that tree, every remaining branch has to carry a massive amount of weight. Which brings us to the actual physical reality of mining.
Which is much grittier.
Yeah, the financial weather is great, but the actual weather and the literal geology of the earth is putting up a massive fight.
Mother Nature does not care about a $4,900 gold price.
Let's look at their operation in Cadia over in Australia. The filing details that on April 14, 2026, a 4.5 magnitude earthquake struck right near their operation.
And we really have to clarify what that means for a mine. This isn't just a surface tremor rattling some coffee cups in an office. This forced an immediate, temporary suspension of their underground mining activities.
Which is terrifying.
Absolutely. When your employees are working miles deep inside the crust of the earth, a 4.5 earthquake is a catastrophic risk to life, to ventilation shafts, to structural supports. The Earth is quite literally trying to crush the operation.
And as if tectonic plate shifting wasn't enough, in that exact same area, they are facing a class action lawsuit from the surrounding community.
Yes, over environmental concerns.
The locals are suing over alleged dust and fluid emissions contaminating the land and waterways.
It highlights the dual threat of physical extraction. First, you're battling the physical limits of the Earth just to get the rock out safely.
Right.
Second, you're battling the environmental footprint of testing those limits, which inevitably impacts the local ecosystem.
And the hits keep coming. Let's stay in Australia, but go over to Boddington. Gold production there decreased 12%.
Due to fires, right.
Yeah. Raging bushfires swept through the area and damaged their infrastructure. They had to pour money into unexpected repair costs just to get the lights back on.
Wow.
And then, if you fly over to South America, to their Cerro Negro mine in Argentina, they are facing a completely different kind of natural disaster.
Right. In Argentina, the disaster is entirely economic, but it is just as destructive to operations as a bushfire.
The 10Q notes the mine is operating in a hyperinflationary economy. The IMF just had to step in and approve a $20 billion extended arrangement.
Which shakes everything up.
Because of that, Argentina shifted to a newly managed floating exchange rate for the peso. The currency is floating and shifting by 1% a month.
That is wild.
So wait a minute, we just talked about billions of dollars in profit, but practically, how does a CFO even plan for this? How do you write a quarterly budget when you don't know if an earthquake will shut down your shafts, a fire will burn your electrical grid, or hyperinflation will make your local payroll cost 12% more by the end of the year?
Well, that is the defining question of global mining. And the reality is, you can't prevent any of those things.
You just have to deal with them.
Exactly. Acts of God and macroeconomic collapses are simply baked into the cost of doing business.
I guess you can't put a gold mine in a safe, climate-controlled office park in Geneva.
Exactly. You have to go where the geology dictates. The why behind Newmont's survival here is that they operate essentially like a decentralized nation-state.
What do you mean by that? Like a nation state?
Through geographic diversification. If you are a mid-tier mining company with only 1 or 2 mines, that bushfire in Boddington or that earthquake in Cadia would absolutely bankrupt you.
Because your cash flow drops to zero overnight.
Right. But for Newmont,
Yeah.
because they are spread across multiple continents, a massive localized shock in Australia or Argentina is financially absorbed.
Oh, because operations in other jurisdictions are still running.
Exactly. Places like Peñasquito in Mexico or Yanacocha in Peru are still churning out thousands of ounces a day. The global portfolio acts as a shock absorber. They use the scale of the planet to hedge against the localized hostility of the planet.
That makes perfect sense.
Right.
So the physical Earth fights back, making every ounce incredibly difficult to extract.
Which creates scarcity.
And that scarcity is what drives the value up to $4,900. But here's where it gets really interesting. The moment a resource becomes that valuable, the human beings and the legal agreements holding the whole operation together start to fracture.
Exactly. When the pie gets that big, the friction over how it's sliced intensifies dramatically.
Let's look at the Nevada gold mines, referred to as NGM in the document. This is a massive joint venture. Newmont owns 38.5% of it, but their major corporate rival, Barrick, actually operates the site.
Right.
In February 2026, Newmont sent Barrick a formal notice of default.
And just to be completely clear to you listening, we are strictly imparting what is documented in Newmont's SEC filing here.
Absolutely, 100% impartial reporting of the filing.
These are allegations recorded in a legal disclosure. We are not taking sides or endorsing the viewpoints of either corporation in this dispute.
Right. According to the 10Q, Newmont alleges that there is evidence of mismanagement by Barrick. Specifically, Newmont accuses Barrick of taking shared resources, like equipment, personnel, focus, and diverting them away from the shared NGM joint venture to benefit Barrick's own wholly owned adjacent property, which is called 4 Mile.
It's a fascinating look at the fragility of joint ventures. I mean, when gold is at $1,500 an ounce, maybe a shared truck or a diverted drill rig isn't worth starting a corporate war over.
Right, it's just a rounding error.
But at $4,900 an ounce, every single hour of labor, every cubic ton of ore moved is worth exponentially more. The value of the asset completely destabilizes the trust between partners.
And it's not just corporate partners feeling that friction, it's the host countries where these mines are located. Let's travel to Ghana.
Oh, the Ghana situation is a perfect example.
Yeah. Newmont operated there under a revised investment agreement, basically a contract with the sovereign government that locked in the tax rates and royalties to give Newmont predictability. Well, that agreement expired on December 31st, 2025.
And the government of Ghana, watching the global price of gold soar to historic anomalies, naturally updated the terms to reflect the new reality.
They sure did. The corporate tax rate jumped from 32.5% to 35%.
Huge.
And the royalties, they have to pay the government. They changed it to a sliding scale that goes up to 12%, depending on the price of gold. Plus, the government gets a 10% free carried interest in the operations. I mean, break that down for us, because those terms sound like a forecasting nightmare.
Oh, they are. Let's start with the sliding scale royalty. Instead of paying a flat 5% fee on whatever they pull out of the ground, the fee changes based on global markets.
So they get penalized for a good market.
Exactly. If gold spikes, Ghana takes a bigger percentage of the top-line revenue. It prevents Newmont from capturing all the upside of a market boom.
And that 10% free carried interest.
Okay, imagine you build a massive billion-dollar bakery. You pay for the land, the ovens, the flour, and the staff. A free carried interest means the government automatically gets 10% of the profits from the cupcakes without ever having to contribute a single dollar to the capital costs of building or running the bakery.
Wow.
Yeah. If we connect this to the bigger picture, this is a textbook example of resource nationalism. It happens globally across all commodities.
Because the countries want their share.
Exactly. When prices hit record highs, the sovereign nations hosting these mines look at the foreign corporations making billions and say, hey, that wealth is being extracted from our sovereign soil. Our citizens deserve a much larger slice of the upside.
Which is fair, honestly.
It's an unavoidable structural risk of global mining. You can master the geology, but you are always at the mercy of the local geopolitics.
It really makes you realize that extracting the gold from solid rock miles underground might actually be easier than navigating the legal battles required to keep it.
Very true.
Which brings me to the craziest story in this entire 10Q filing. The CC&V mine in Colorado.
Yes. The ghost tunnel.
Yes. Now remember earlier we talked about Newmont pruning the tree. They sold the CC&V mine. They fully divested it to a company called SSR Mining.
But in the world of heavy industry, you rarely get to walk away clean.
No, you do not. They sold the mine, but they are still haunted by a hole in the ground dug in 1941. It's called the Carlton Tunnel. It was built during World War II just to drain water away from a mining district.
Over 80 years ago.
Fast forward 80 years, and Colorado regulators are demanding a water discharge permit for that exact tunnel, imposing strict new water quality limits.
And Newmont is fighting back.
Newmont is in federal court right now suing the state. They're claiming the water coming out of that historic tunnel is akin to natural spring water and legally shouldn't even need a permit.
And because of the fine print in their divestiture agreement, Newmont can't just ignore it.
It's exactly. The filing states that Newmont is still on the hook for 90% of certain closure and reclamation costs if those costs exceed $500 million.
Wow. Let that sink in.
Right. They successfully sold the asset. They don't get the gold from it anymore. But because of a tunnel dug before most of their current employees were even born, they could face massive environmental liabilities.
It proves a fundamental rule of resource extraction. Environmental liabilities are practically immortal. They last decades longer than the profit cycles of the actual mine.
You can sell the machinery.
Yeah, you can sell machinery, you can sell the land, but you cannot easily sell the long-term environmental consequences.
So let's look at the board here. We've got an incredibly hostile environment. Earthquakes halting production, fires burning infrastructure, hyperinflation destroying payroll predictability.
Corporate partners allegedly diverting resources.
Host nations hiking taxes on a sliding scale, and lawsuits over 80-year-old water tunnels.
Yeah.
But despite all of that chaos, the $4,900 gold price means billions of dollars are still flowing in.
Which brings us from the muddy trenches of the mines straight into the boardroom.
Right. Where does a company actually put billions of dollars in cash?
This is where we see Newmont's ultimate philosophy on capital allocation. When you have an influx of extreme wealth, your choices basically define your corporate future.
The filing shows that in just the first 3 months of 2026, Newmont repurchased nearly $1.9 billion of their own common stock.
Just in one quarter.
And then in April, the board authorized a staggering new $6 billion stock repurchase program. $6 billion.
This raises an important question for you to think about as you navigate the business world. What does a massive share buyback actually signal in a commodity boom?
Right, because they could take that $6 billion and go buy a rival mining company.
Exactly. They could acquire a dozen new exploration sites. They have the cash to expand the empire.
They aren't doing that.
And the reason why is rooted in market cycle awareness. In a high-price environment where gold is at $4,900, buying a new mine is wildly expensive. The seller knows exactly what their unmined gold is worth, so the premium is massive.
Oh, that makes sense.
By executing a $6 billion buyback instead of an acquisition spree, Newmont is signaling extreme confidence in the Tier 1 assets they already hold.
They're essentially betting on themselves.
Yeah. They are basically saying, the most undervalued asset on the market right now isn't someone else's expensive mine, it's our own company.
By reducing the total number of shares available on the market, they make every remaining share held by an investor intrinsically more valuable.
Exactly. They are returning the windfall to their shareholders.
So what does this all mean for the people actually pulling the levers? The board of directors.
The ones making these massive decisions.
Right. This brings me to Exhibit 10.1. The corporate governance document attached to the SEC filing. This outlines how the directors themselves are compensated for managing all this chaos.
It's pretty revealing.
They are granted what are called restricted stock units, or DSUs.
Deferred stock units.
Right, deferred. Now, here is the mechanic of how these work. These units vest immediately. The director earns them right away for their service. But they are not actually delivered to the director as tangible, sellable shares of stock until 30 days after the director retires or separates from the board.
And that timeline is ironclad. Even in the event of the director's death, the shares aren't delivered until after that separation period.
I call this the golden handcuffs with a delayed lock.
I love that phrase.
Think about human nature and corporate greed. If a director got those shares today, in the middle of a historic $4,900 gold boom, they would be massively tempted to make short-term decisions that artificially pump up the stock price right now.
So they could sell their shares, cash out, and walk away rich before the market corrects.
Exactly.
And short-term incentives create long-term disasters.
But by structurally forcing them to hold the shares until 30 days after they leave the company, you completely alter their psychological incentives.
You bind their personal generational wealth to the ultimate long-term health of the company.
Yes. They are forced to care about what Newmont looks like 5, 10, 20 years from now.
They have to care about the legal strategy surrounding the 1941 Carlton Tunnel water dispute.
Right. They have to care about maintaining a healthy, sustainable relationship with the sovereign government of Ghana.
Because if they make reckless choices today to juice the quarterly numbers and leave a massive structural mess behind,
the stock will tank exactly when they finally get the keys to unlock their golden handcuffs.
It is a profoundly elegant piece of corporate governance. I mean, it physically forces the humans in the climate-controlled boardroom to align their incentives with the long-term, multi-decade survival required to fight Mother Nature down in the mines.
It really is brilliant. So let's take a step back and look at the entire journey we just took.
We covered a lot of ground.
We started with what looked like a dry, boring SEC Form 10Q, just mandatory columns of numbers. But hidden inside the fine print was a massive global geopolitical narrative.
We found a company writing a historic $4,900 gold wave, intentionally pruning their weaker operations to concentrate a massive bounty of profit.
We saw them taking literal physical hits from the underground earthquakes in Australia, bushfires, hyperinflation in Argentina, and absorbing them through the scale of a decentralized global portfolio.
We watched them navigate corporate betrayals and sovereign nations demanding their rightful share of a skyrocketing commodity.
And finally, we saw them playing a multi-billion-dollar long game, executing massive buybacks and utilizing delayed stock units to lock their own leadership into the future consequences of their actions.
And this matters to you whether you actively invest in the stock market or not.
Exactly, because this isn't just an abstract corporate case study.
Right. The highly conductive materials inside the smartphone you're using right now, the foundational stability of your investments, the actual physical backing of global currency, all of it is pulled from the earth through this exact chaotic, highly political, high-stakes process.
The spreadsheet is just the scorecard. The game itself is wild.
Exactly. But I want to leave you with one final provocative thought to mull over, building on the very premise of this financial windfall.
Okay, lay it on us.
We talked about how geopolitical tensions, military activity in Ukraine and the Middle East, and global supply chain disruptions are explicitly listed in these filings as massive risks to Newmont's operations.
Yep, they are front and center in the risk factors.
Yet those very same fears are exactly what drive global investors to safe havens, pushing the price of gold to this record-shattering $4,900 an ounce in the first place.
Right. Global fear directly drives the price up, which makes them rich.
So here's the question you have to ask yourself. Is a record gold price of $4,900 an ounce actually a sign of a thriving, successful global mining industry? Or is it a warning flare?
Oh, wow.
Is it a symptom of extreme global anxiety and a deep structural distrust in fiat currency that will ultimately threaten the very energy grids, the fuel prices, and the global supply chains that these massive mining companies desperately rely on just to keep their machines running?
That is a fascinating contradiction.
If the world gets scared enough to drive gold to $4,900, is the world stable enough to actually allow a company to mine it?
Wow, that is a heavy, fascinating thought to leave on. The very macroeconomic terror making them incredibly rich might eventually be the exact thing that makes it impossible to operate. Thank you for joining us on this deep dive. Next time you see a dry financial spreadsheet, just remember there is always a high-stakes thriller hiding in the fine print. Keep seeking out the stories hidden inside the data, and we'll catch you next time.